markets were getting a little bit busier right ahead of this update and after the ECB decision, but overall on the day, not all that much activity as far as where we were relative to opening levels. Aussie and Kiwi led the way, but were contained to well within 0.5%. The gains here came on the back of another attempt at a recovery in the stock market, which isn't all that encouraging considering our view that the US equity market has a lot more downside to come, as a long overdue correction looks like it could be taking form. It's worth reminding that the last big pullback in stocks came back in 2015 and into 2016 as the market panicked on the very thought of a taper. Those declines from high to low were about 16% before the market ran up again and continued to make record highs right up into recent weeks. At this stage in the game, the correction in the S&P 500 has been about 10%, and this is with rates having moved up to a point where the pain can actually be felt now, and with the market that much more extended. So a pullback that matches the one seen in 2015 should be well within reason, with rates having moved up into the realm of near normal now. This would mean a very realistic S&P 500 drop to 2470 to match that previous 16% decline that was seen into 2016. We think after all is said and done, in reality, the drop could be twice as big as that. Back over to FX, the ECB decision has come and gone and pretty much without a hitch. We had said in our preview piece that with the ECB already hitting the pause button on consideration for a rate hike until the summer of 2019, there wasn't much room for the central bank to be making too many waves. There was some talking down of the euro in various ways, but this was to be expected, and outside of this having a short-term impact over a session or two, we don't think this will have any lasting effect. The US dollar has been bid overall of late as it benefits from both safety bids and yield differentials at the same time, though we have cautioned against expectations that this will keep up with the U.S. trade policy and the possibility that the Fed is forced to reconsider its timeline on account of falling stocks, very capable of reversing this flow. The fact that additional dollar upside is a tremendous danger to emerging markets is another important consideration that should be made as far as the health of the global economy goes. The pound was taking that hit late in the day, presumably on more Brexit worry continuing to extend its run of underperformance, though we saw nothing specific on the wires at the time of this update. Looking ahead to Friday, the data of note is all out of the U.S. with GDP, core PCE, and Michigan sentiment due. The market will continue to monitor the bigger macro stories, global trade, Brexit, Italy, emerging markets, and the performance in the U.S. equity market. That's all for now.